In this session, we will consider a popular FX market strategy referred to as the carry trade. By the end of the session, you'll be able to define the key characteristics of a carry trade, calculate the profit or loss from a carry trade, and identify the associated risks. As ever, it's important to start off with a few definitions. What is a carry trade? Although this could take many forms, we will focus on the FX variant. In simplified terms, it involves depositing money in a higher yielding currency, which is financed by borrowing in a lower yielding currency. As ever, a worked example will help illustrate. Suppose that the following 12-month rates are observed in the market. In the following calculations, an actual day basis will be assumed. Yen interest rates will be 0.15%, 15 basis points. South African rates will be 8.25%, and the spot exchange rate between South African rand and Japanese yen will be 1 rand equals 7.877 yen. For clarification purposes, I have assumed that the rand is the base currency, and so the quote represents the amount of yen per rand. An investor borrows 100 million yen for 12 months at a cost of 15 basis points per annum. Total borrowing cost is therefore 150,000 yen payable at maturity. The investor sells the 100 million yen in the spot market and receives the South African rand equivalent, 12,695,189. These rands are placed on deposit for 12 months to earn 8.25%, which gives us interest of 1,047,353 rand. Upon the maturity of the South African rand deposit, the process is reversed. The ZAR principal and interest of 13,742,542 is converted back to yen at the prevailing spot rate. If we were to start off by assuming that the spot rate has not changed over the course of the year, the investor receives back yen equal to 108,250,003. This income is then used to repay the yen loan of 100,150,000. The investor is left with a positive balance of 8,100,003 yen. This is about 55,000 US dollars, depending on which exchange rate that you use. On the surface, this would appear to be a very easy way of making money, but, and there's always a but, the example assumes that the exchange rate has been stable. This highlights one of the key aspects of the carry trade. It makes money when nothing happens. To understand the issues more deeply, let us revisit the content discussed in the forward market module. In that module, we calculated the forward rate as the ratio of the interest rates in the respective currencies. Using standard forward rate calculations, the 1-year ZAR yen rate is 7.2876. The currency with the higher rate, in this case rand, will trade at a discount in the forward market. Here, the FX trader will earn fewer yen per unit of South African rand than in the spot market. An investor seeking to earn a return in the higher yielding currency and selling that currency forward to obtain cash flow certainty will earn a return equal to that of the counter currency. So using the previous figures, if the investor had agreed to sell the proceeds of their rand investment at the initial forward rate, then they would receive back 100,150,000 yen. Admittedly, there is an element of rounding in my calculation. So what does this mean? Hedging a carry trade would result in zero profit or loss. If the investor wishes to earn a profit, then they must leave the position unhedged and hope that nothing will happen. That is, that the exchange rate will remain stable. But we can see that although the investor would not use the forward to hedge their position, it does indicate their break-even point. As long as the rand does not depreciate below the forward rate of 7.2876 yen, they will earn a profit. Discussing this strategy with an FX trader, he argued that the reason why so many people are prepared to take the risk of the carry trade is that because, in the real world, high interest rate currencies tend to attract investor inflows at the expense of the low interest rate ones. This leads to a strengthening of the currency. This is opposite to the theory which suggests that a high interest rate is often associated with high inflation, which would often result in a depreciating currency as investors become concerned about the erosion of their purchasing power. So if you borrow the low interest currency and invest in the higher interest currency, on balance, not only do you get the interest differential, but you should get a pickup in the form of being long an appreciating currency. However, it then becomes an issue of timing. If there's a change in sentiment, you need to be out of the door before everyone else, as there's a tendency for everyone to start running for the exits at once, which could lead to a nasty correction. So what are the key takeaways? A carry trade is analogous to selling insurance. The investor will earn a return if nothing happens, but there is a risk that their earnings could be hit by occasional large losses. The strategy will generate a profit if the underlying exchange rate is not as volatile as expected. But there is a risk that the high interest rate currency will depreciate against the low interest rate currency, and the associated capital loss will be greater than the net interest gain.